One and all, it is Friday the 6th. Hopefully you had an awesome Cinco de Mayo. Don't know what you guys did. I got to spend some time with some business partners, friends. Scotty, we were out last night talking business, getting a steak. Didn't do the taco thing. I guess, we broke that. Well, it wasn't even a tradition. We just went completely out of what one would be doing, going out with his buddies on Cinco de Mayo. We sat down and discussed other things. So but what we got going on here in the market this week was a decent week. It still had some interesting effects in the market. You had the Fed come out and talking about raising the rates. They did raised it to half a point, right? So 0.5%. There was conversation about being 3/4 of a point. There was one part in the conversation. The question was asked of Jerome Powell: "Are you going to think you guys going to raise it 0.75%?" He says, "No, we're not considering that." That caused a kind of a frenzy-like rally, if you will, in the bonds. A lot of buying going on. But what was interesting, in fact, I'll just get into the chart here, is that that didn't last long. So, I mean, it blew up right here that day. As you can see, this was a big day of movement. You see our other days of movement, but look at this green bar right here. That was that day. Massive movement, broke us out of where we were in the channel. We're underneath the channel line where we were riding above it, then we're back underneath it. Powell speaks. They ask about 3/4 point raise. He says, "We're not considering it." Bam. Unremarkable rally, which was kind of cool, right? We thought this might be a good spot for us. And then the very next day, everything was given up. But so we had a great rally, and it's encouraging, right? But it's not something that we were able to see as a sustainable. Well, we didn't see it translate into market. Nothing was going to be translated into interest rates at that point, because you've got to look at this whole history. All this from, we're talking about 800 basis points in drop from its peak. That's a lot of negative movement. One day is not going to get anybody excited. And then you see the trading that went on, because these are trades, people buying into the mortgage-backed securities. But those who are buying into that were more of your smaller operations. The bigger operations were not buying into it, and bam, they're the ones that sold out after this. So I think that they played it, understanding the emotion going into this, others buying in as a good thing, and they sold their positions the next day, literally making money on the deal, is what I understand. I can be off on that. I'm just gathering data. So I get this, and now we're back down to where we were, right? Above the trend line, but the trend line is still downward. So where do we sit? We sit in the same place we've been sitting for a very long time, which is lock it if you got it. Don't look backwards and quit wondering if it's going to get better. I don't see where it's going to get better as far as rates are concerned. Where it's better, and it continues to get better, is that rates are moving at a slower pace than inflation. That's where it's better. Go back to what I keep saying. I'm going to keep saying it and keep saying it until I stop getting phone calls asking about it. And it's probably never going to happen, because not everybody's listening, not everybody's watching. But inflation going up the way that it is, outpacing the interest rates the way that it is, you're literally paying less money. So go back to when it was 4%, it felt awesome. There's 4 or 4.5%, and you're lamenting not being able to get those anymore. But inflation was supposed to, or the CPI was supposed to be 2 to 2.5. That's a 2% differential against you, right? Your money you're basically paying more than the rate of inflation, right? Somebody else is making money off you in that. Flip it today, 8.5%, and let's say 6.1% in interest rate. Well, now they're making money on you, right? Because you're the one giving it back to that. You're the one whose money is eroding faster, right? Actually, excuse me, I'll flip it around. You're making money on them. Sorry, I got that backwards. You're making money on them. You're giving them back something worth less while you're paying them something lower than what the value of that capital is doing. You're in a better position. Get the rate number out of your head and look at it from a market perspective. Look at it from a businessman's perspective, a businesswoman, just a CEO's perspective. What's my cost, right? And what is my income? Right? What is the dollar? What is the instrument that I have worth to me versus what I'm spending when I use somebody else's money? You're going to use somebody else's money at way less than what it's costing you to have that money. So when you think about that, you're winning. You're winning 2% on it, where before you're losing 2%. I'm hoping that's making sense, and that it's right, because it works great in my head. Beginning to go from my head to my mouth is a little bit tough. I'm trying to beat that down in a way to where it makes more sense. But ultimately, you're gaining 2% versus losing 2% if we're just looking at the CPI. But we know the CPI is bullshit. We know the real rate of inflation is over 16, so you're making 10+%. Get the rate itself out of your freaking head now and look at the market itself and how a CEO looks at their business. They don't care what the cost of things. If you're a steel building company, you don't care what the cost of steel is when compared to what you can sell it. As long as you're selling at a profit and you got a margin, who cares, right? Doesn't matter. As long as there's margin, your margin stays the same. Your margin just got better by 4%. Because it's 2% the other direction, that's 2% this direction. That's a 4% gap. You got a 4% improvement in your personal margin. So it shouldn't matter to you what it costs to get the goods before you sell it if the marketplace is going to give you 4% more for the goods that you're selling. Think of it that way. When you understand it in that perspective, you're not losing, you're kicking ass. And the people out there that are lamenting the interest rates and getting out of buying right now, they're the ones losing. The ones that are out there paying cash, they're losing because they have taken all their capital and dumped into one place. And then they don't refinance to get their money out because the rates are so damn high. Therefore, they don't have the disposable capital to play into multiple properties like you do. So don't get caught up thinking like that. Think like the CEO that you should be and look at the margin that you're making on it. I'll talk to you guys on Tuesday.